Well, thanks again, Todd, and thanks everyone for having me. I am channeling my inner Sesame Street fan and titling this economic update brought to you by the letter K, because that's the theme that I really want to convey in the discussion this morning with everyone. I'm going to talk about Knightian uncertainty and what it means for the economic outlook. I want to talk about some key risks and the importance of fiscal stimulus as we try to peer into the crystal ball and figure out where the world is going over the next 6 to 12 months. I want to discuss a K-shaped recovery and what it explicitly means for things like retail and net lease. And then lastly, I want to make sure everyone keeps retail and net lease on their radar screen. I probably don't need to tell this audience that, but I think there's some important lessons that we learned during the last recession and recovery that are seemingly forgotten right now that I think at least sometimes I need to remind people of. The first concept I want to discuss, everyone, is this idea of Knightian uncertainty. And I know the layperson tends to think of uncertainty and risk synonymously, but in economics, we don't. And it's an important differentiation that I want to make sure everyone understands. In economics, we think of uncertainty as something that lacks quantifiable knowledge. There's not enough data, there's not enough information. We know something could occur, or maybe even is likely to occur, but we don't have enough information about that thing to quantify it. And that differentiates from a risk. A risk is something that I can quantify. So for example, if I want to calculate the volatility in the stock market, I can calculate the standard deviation of the S&P 500. If I want to know the probability that a commercial mortgage might default over the next few years, I can take historical data on defaults. I can build a model, which I've done. You can give me your information on your mortgage. I can run it through my model, and it will spit out a probability that something could occur. But if you ask me the probability that the pandemic is going to get 50% worse over the next 6 months, I don't have a really good way to quantify that. Or the probability that everyone will have a vaccine by the middle of next year, I have a little more transparency on that now, but I still can't really quantify that. And that's a problem for us as we try to grapple with the crystal ball and figure out where the world is going. I objectively think that the recession is likely over. We saw the economy start to grow in the third quarter, and all of my modeling generally predicts that the economy should continue to grow as we look out over the next 2, 3, 4, 5 years. I try not to peer into the crystal ball too far beyond that because it becomes like throwing darts at a certain point. But that said, we do face some key risks, at least when I think about my base case scenario and where the world could be going. I want to start over on the left and work my way over to the right. Clearly, if you're paying attention to what is going on in the world, you are not alien to this idea of secondary lockdowns. What I mean by that is that government officials are now starting to lock down, shut down parts of the economy again, reinitiating things like curfews, like capacity constraints on businesses, shutting down certain businesses outright. I'm concerned about this because this is a constraint on the supply side of the economy. If these businesses can't operate at normal capacity, we can't go and frequent them the way that we normally do. That produces headwinds for the economy. The second key risk is what I'm calling human behavior. The idea that certain individuals will decide just to opt out of activities out of fear of falling ill. Right now, Todd and I were discussing this before, there's no government edict that says I can't get on an airplane and go speak in front of an audience somewhere if we follow the local guidelines. But I'm not doing that because there isn't a really good, compelling reason to do that right now. And I'm not also willing to take that risk with my family. And not a lot of people really are right now. Most people, in fact, are opting out of activities like indoor dining and getting on an airplane. And that's a constraint on the demand side of the economy, which brings me to the third key risk that I want to discuss, this idea of austerity. And what I mean by austerity is the fact that fiscal stimulus has not fully expired, but largely expired at this point. The last vestiges of it are going to roll off over the next month or so by the end of the year. And that to me is a risk because as much as I've been touting the strength of the economic recovery up to this point, a lot of that is due to the benefits of government support for both consumers and businesses. And if we continue to lose that support, it is going to increasingly become a headwind for the next 6, 7 months. There's a lot of daylight between now and when everyone gets a vaccine and we can start to resume our fairly typical economic lives. There's a lot that can go wrong between now and then. And this is why, even as a pretty laissez-faire, free market-oriented economist, I'm concerned about the fact that if we're not providing support, then the economy can't fully self-correct if we have secondary lockdowns, shutdowns, curfews, and a lot of people feel unsafe about re-engaging in different economic activities. What that does for us is it's producing what I've been calling a K-shaped recovery. And I can't promise you that I was the first person to use this term, but I feel pretty confident in saying I was in the vanguard of individuals that started using this back in the summer. And it doesn't mean that I'm explicitly thinking that we are going to get a recovery that looks like the letter K. I use this as a tool to really wrap everyone's minds around the fact that even relative to a normal, whatever normal used to be, normal economic recovery, this is a very uneven recovery. And the way that I'm demonstrating that is that I'm mapping households to the different legs of the K on this slide. For example, there are some households that have financially fared even better because of this recession. If you work for a technology company, if you happen to be a big investor in a technology company, you have benefited because of this, because professionals like us are generally able to go about most, if not all, of our typical work lives via technology. It makes perfect sense that they've benefited from that. Consumers have also done the same thing. When they have decided to opt out of things like going shopping or indoor dining, they have utilized technology. Therefore, there's a small pool of people, small pool of households out there that are faring even better financially than before this downturn. That diagonal leg up of the K, that's kind of us. I don't want to throw everyone into this category, but that's the professional class, the investor class. We didn't really come through this unscathed. I'm not sure anyone came through this perfectly unscathed, but we have largely or fully recovered at this point. And with markets pushing new highs and most of that part of the labor market doing well, we're hanging in there. We're doing okay. Maybe not thrilled with what we've seen in 2020. Not sure anyone is, but we have weathered the storm relatively well. Then if we go to the diagonal down leg of the K, that darker gray color, there are some households that are still continuing to struggle. We are net short about 10.1 million jobs relative to the high back in February. And there are a lot of households that don't participate in the benefits that the top half of the K have, like home ownership, which is booming in terms of housing values and demand for housing, like publicly traded markets, where both equity markets and fixed income markets are really pushing record high levels right now. And then unfortunately, there's that red vertical downward leg of the K, where you see households that are still facing some pretty severe problems right now. Food insecurity, potentially housing insecurity if some of the programs in place that prevent things like evictions start to roll off of the books. What that is doing for us, again, is it's producing a very, very uneven economic recovery relative to a typical economic recovery. And that is manifesting itself in certain ways, especially when we start to think about retail and net lease. And what it's really doing is it's creating this bifurcation in the market, because what's happening is the middle of the retail market continues to get hollowed out. And to be fair, this is the continuation of a trend that we saw going back to the last recession. After the residential real estate bubble burst, and a lot of that phantom demand for retail, which was predicated on inflated housing values, started to go away, what you saw was this hollowing out of the middle. And that's because consumers at the top, they're not immune to the vagaries of the business cycle, but they're pretty insulated. They often don't trade down to the middle. Consumers in the middle that to a large extent have never fully recovered from the last recession shifted down to the bottom. And then I don't mean to be harsh about this, but as a statement of fact, the consumers at the bottom were already at the bottom. Therefore, there's been this loss in the middle of demand. And you really see that in terms of the retailer performance. Mid-priced apparel retailers, department stores, they make up more than a third of the bankruptcies that we've seen in 2020 amongst retailers. And again, this is not a new phenomenon. This is a continuation of a trend that we saw over the last 10 years, whereby the top of the market has performed relatively well. The bottom of the market has performed relatively well. And it's been the middle of the market that really continues to struggle. And I think about this crisis for the economy and for retailers the same way that doctors think about it for patients. If you had a pre-existing condition going into this, well, then COVID is not your friend. It is going to exacerbate and probably accelerate those underlying trends. But if you happen to be relatively healthy, relatively stout, good constitution, you can weather things like this. Again, I'm not saying that you've come through this unscathed, but you've probably come through this much better than the middle, which continues to experience weakness. Not only are we seeing this in terms of the failures of retailers by this kind of K-shaped distribution, But we also see it in the performance of what people are doing with their money in 2020 as it reflects the pandemic and this K-shaped environment. If you look over on the right, at least through August, you can see the components of retail that have been faring the strongest over the last year. Not surprisingly, non-store retailers have fared well. Again, it's that technology component that they're benefiting from. But then people focusing on being at home. Home improvement and home furnishings have done well. Sporting goods, I will be the first person to admit, I was buying home sporting goods before this happened. I have increased my consumption of home goods because I don't yet feel safe going back to my gym. I definitely fall in that category. Grocery, not a surprise. Health and beauty, obviously not a surprise. Even auto parts and dealers to a certain extent. People still have to get around. They have to get to their jobs. But if you look at the red bars below the total performance, you definitely see some issues there. And that reflects this idea of this K-shaped recovery, that a lot of households that are in those down legs of the K that are struggling, they are not going out and spending a lot of money in a very discretionary manner. They're focusing on very non-discretionaries. It's households in the top of the K that are focusing on the higher end discretionary products. But that unfortunately leaves a lot of these categories that still are facing shortfalls relative to the overall market at a minimum. That said, even though I expect us to go through some pain on this, I do expect the overall market to recover. I have been modeling the overall economy and the real estate markets as a scenario-based approach, given the massive uncertainty that we are still dealing with. What I would say to take away from this as a heartening sign is that across all of my scenarios, even the most severe, we still generally expect this to last maybe a couple of years and then start to see the retail market recovering as the overall economy recovers. And I think a big catalyst for that will be getting the vaccines, hopefully, fingers crossed, maybe not holding our breath, but by the middle of next year, as we start to move past the pandemic, there's a lot of pent-up demand for people to go into stores again, into retail centers, to go to bars and to go to restaurants and to start to travel. And all of that is good for the retail sector. Whether it comes sooner than later, again, there's a lot of uncertainty about this, so it's hard to have perfect transparency, but I don't doubt this is coming. Therefore, whether you're relatively optimistic about where we are going over the next 12 to 24 months, or you're a little more pessimistic about where we are going over the next 12 to 24 months, I'm here to tell you that barring some massively unpredictable severe circumstances, I generally expect the market to go through a bit of a downturn, stabilize, and then start to recover on the other side of this crisis. And that brings me specifically to talking about net lease within the context of retail. Fine, all well and good that I think retail is going to bounce back. What about the thesis for net lease in particular? And that's where I remind everyone of what's going on with interest rates. If you've been paying attention, and I'm sure most of you have, you know that interest rates are still hovering at or near record low levels. And that's because the Fed is doing everything it possibly can to put support underneath the economy. The Fed is not comprised of superheroes. They can't fix everything, but doing what they can, they have lowered interest rates basically back to where they were during the last recession, effectively at or near zero. Why that matters for net lease is in a world that continues to chase yield. And I see this all the time with the clients that I'm working with, even in my own real estate investments, which I do on the side. The world is out there chasing yield wherever they can find it. And it's becoming more acute and competitive in a world where interest rates are basically at zero. My thought on this is that the Fed is going to err on the side of caution, and they have so much as telegraphed this, even relative to the last cycle. They've changed their stance on inflation a little bit to the point where they will probably let inflation run a little bit hot longer than they otherwise normally would, which means as long as interest rates stay at or near record low levels for a prolonged period of time, that creates even more of a sound thesis for owning real estate assets like triple net, where they produce consistent, stable cash flows. There's an attractive spread relative to risk-free or near risk-free assets. I think a lot of investors get this, and I think that will become more apparent over time as we continue to move past the pandemic. But interest rates generally stay at relatively low levels, sort of like what we saw during the last recovery, where even though as we started to see convalescence in the economy, you saw interest rates staying at or near really low levels. So just to summarize real quick, I do think that nutty and uncertainty is still prevailing. We have to be on guard for that. Don't let your guard down just because we're starting to see better information on vaccines and light at the end of the tunnel. Like I said, there's a lot that can happen between now and 7 months down the road. I think we have to watch for the uncertainty of things like pandemics and vaccine distribution. Key risks are increasing, unfortunately. The pandemic is worsening. We are on the clock for fiscal stimulus right now. They're not abating. That doesn't mean they're going to fully materialize, but again, keep your eyes on them. And then lastly, keep sight of retail. I probably don't need to tell that to this audience. I'm preaching to the choir a little bit, but a lot of people made this mistake during the last recovery. They painted with a very broad brush. They wrote off retail, the entire sector, and they made mistakes. A lot of enterprising investors who didn't do that made some serious returns and some serious money. And I would just remind everyone of that it's very dangerous to be that broad sweeping about an entire asset class within commercial real estate. It was a mistake the last cycle. It will be a mistake again this cycle. And with that, I will conclude my remarks. Thank you very much for having me. Always great to do this.
I got a quick question for you.
Sure thing.
Just on the recovery. So we as an event company have to plan. How are things going to go? What is it? March? Is it April? Is it May? Is it June? And I think I can figure that out because I think I know where the vaccine is going to go. But what I worry about, we do live events, and we've done a couple for smaller crowds, and the people that are unemployed are the lowest tier. You know, it's the people who are serving the food at our events, who are cleaning the facilities. That group of lower income people, are they going to be hurting for a long time, and will that be a drag on the recovery?
Some of them will. To be fair, some of them will. What we're starting to see, unfortunately, is that among that group, you're starting to see more prevalence, increased prevalence of long-term unemployment, which the research shows produces long-term structural damage to the economy. I don't think they'll all be in that position, because the good news about this is, as long as businesses don't fail, which again is why I'm banging on about the need for government support, as long as businesses don't fail, once their demand for their products and services come back, they'll be able to rehire people. And you've seen that over the last 6 to 7 months, which is what makes me feel confident in saying that. So as long as we are really going to start distributing vaccines over the next 6 to 7 months, and that demand side impairment starts to abate, those businesses will see demand go up, they will see revenue go up, they will start to rehire. So the big thing that we have to do to short circuit that long-term damage process is to make sure that businesses don't fail, so that they are still in existence to rehire people back on the other side of this. Even through this, like I said, as we start to immunize people, they will start to go out and re-engage the economy. Demand will come back. It's more a matter of when than if at this point, but we need to limit the long-term structural damage before that happens.
Well, amen. I look forward to recovering